The following is a presentation of TFNN. The Morning Market Kickoff with your host, Tommy O'Brien. Now, Tommy O'Brien.
Good morning, everybody. I'm Tommy O'Brien, coming to you live from TFNN Wednesday morning, just after 9 a.m. Eastern Time. We got about 24 minutes to go until the start of trading. We have markets extending the gains from yesterday. You're up 12 points right now in the S&Ps, trading at 39.52. We are one day out from a very important CPI number tomorrow, 8:30 Eastern Time. The market will get ready for that today. We get the NASDAQ 100. We're up by 25 points right now, 11,307. You see, we had the Monday sell-off, and markets almost getting right back up to those Monday highs, man. And you talk about volatility, folks. That's almost a move of 300 points in the NASDAQ 100. You're talking about a move in the S&Ps that approaches about 90 points from 39.73 down to a low of about 38.91. You get the Dow right now nearing 34,000. We're up as high as 34,080 on Monday. We're at 33,942 in the Russell this morning, well above Monday's highs. You check that out, right? Russell up to 1840 this morning. We're up by about 5 points this morning in the Russell. Bitcoin holding pretty well, 17,425. Crude catching a bid, man. You talk about volatility. Crude this morning, 74.50. $77 we just hit in the price of crude, man. We're going to be talking to our man Teddy Kegstad at 40 past the hour. He writes the Tiger Forex Report, folks. An outstanding newsletter comes out every Monday. You can check that out under the newsletter tab at TFNN. We'll talk to him at 40 past the hour. Always an interesting conversation, especially with what's going on right now in terms of currencies, yields, crude, commodities, etc. Gold up to $18.81. We're up by $4 on the session, but we were higher pre-market to about $18.90. And we jumped to notes and bonds. A little bit of higher price, lower yield, but well off the highs that we had on Monday. You see the acceleration yesterday down to about 113.26 in the 10-year. Right now, you're up by 7 ticks in the 10-year, trading at 114.07. We get the 30-year up by 21 ticks. We jump over the volatility index this morning, 2069. I mean, check it out, right? Well below where we were even on Monday's market high. Volatility really getting paired in this market right now, even coming into a very important CPI number tomorrow, man. Don't underestimate the volatility that could ensue tomorrow at 8:30 as we get inflation numbers for the month of December. And we'll get into them later in the program, folks. But you're talking about a core number. I think we're still talking about 5.7% on the core. I'll pull up those numbers exactly. Month over month core tomorrow is expected to come in at 0.3%. up from 0.2% in November. I'm not sure how you celebrate those types of numbers, folks, but that's what they're talking about in terms of market expectations, and we find out tomorrow at 8:30. We jump around to currencies. Dollar index just kind of sputtering around at about 103, 103.32 to be exact. You see the fall off on Friday from the non-farm payrolls numbers. We put this thing on a daily. Backing off quite a bit, well out of the trend line that we were in for the better part of last year. You break out of that trend line in November, and yeah, we've just been sputtering to lower prices in the dollar index. Let's jump to the euro US dollar this morning, 107.50, far cry from 95 bucks, man. If you were traveling to Europe and you didn't lock in that price, that's unfortunate, folks. You had quite an opportunity to get in anywhere from July all the way to basically November at a price point of parity, even if you just take where it was August 22nd, all the way to basically November 10th, almost 3 full months. You had the euro below parity, and we'll see if the trend stays intact, right? In terms of if where we go, where our interest rates go, where our dollar goes is going to determine a lot in terms of those currencies. And we'll wrap it up with the dollar yen, man. Dollar yen, you talk about volatility. 151.93, that spike high. We're back to 132.60 right now in that dollar yen. All right, let's jump around and see what else we have going on, and we'll kick it off with a little bit of Fed speak. So we have a meeting at the end of this month. I was talking to our man Kevin Hincks yesterday. We'll talk to him after the first break. I was saying it's interesting. We get a Fed meeting January 31st and February 1st, so 3 weeks from today. Then the next meeting is March 21st and 22nd. And then you got to go all the way out to May. So we do get a meeting in 3 weeks. The conversation is whether it's 25 or 50 basis points, okay? But keep in mind that after this meeting at the end of this month, we only have one meeting until May. Do you know how much data we're going to get that's going to allow only one meeting until May? It's January 11th, folks. And yes, we have a meeting at the end of this month, okay? But they are not going to stop cutting at the end of this month. Not going to happen. It's 25 or it's 50. Excuse me, hiking. Hiking. It's 25 or it's 50. So the real conversation is, how high are they going to go? And then you'll see a market exuberance. The moment that they pause, that's step one in the whole transition, right? But then how long are they going to stay there? And I don't see any way that they're budging by that March meeting in terms of not. I believe you're probably going to see at least another 25 basis points in March, and that's like a best case scenario, folks. Okay? That's like saying maybe they go to 25 this meeting and they go to 25 in March. Okay, but if they do that, yes, you might get a little rhetoric to forecast May, but you're going to go all the way out till May, right, to get past the March meeting. There's just so much data, man. I'm not sure how the market's going to meander that, but nonetheless, policymakers insist rates will be held high into 2024. It's possible, man. We're going to talk about the CPI numbers. We're going to look for a CPI number of about 5.7% on a core, which is just astronomical. In any other environment, money markets are pricing in a rate peak around 4.9%, followed by nearly a half percentage point cuts by the end of 2023. Do you think we're getting half percentage point cuts by the end of this year? I don't know, folks. It's going to take some pretty devastating financial recessionary numbers to have the Fed cutting by half a percentage point by the end of this year. Because I just walked you through. If we're cutting by half a percentage point by the end of this year, well, we got one meeting at the end of this month. We got a meeting in March, and then you got May. And I'll pull up the full calendar after this break, maybe after we talk to our man Kevin Hincks. But you can see how it's going to get there pretty quickly, man. And I just don't see the Fed pivoting that quick. And if they do pivot that quick, it would take some really harsh numbers for recessionary indicators to force them to do that, which would hurt the market as well. Okay, so the market has a lot of headwinds right now, man. Rates are heading above 5% and will stay there all year. That's what the Fed is saying. The market's saying we'll reach 4.9 and then we'll cut by 50 basis points by the end of the year. Now, they talk about a lot of Fed speak in here, okay? Just last month, of course, Powell highlighting, warning against prematurely loosening policy. Now, if a falling market rates undercut their efforts to cool the economy, that is a problem, okay? So traders are rejecting the narrative. The risk is that the exuberance over monetary easing causes Fed officials to tighten even more. That's where, like, the game theory of this all gets pretty fascinating. And it is not a game, folks, but there is that theory that applies into it, whereas they don't have to hike and keep them high all year. The market just has to believe that to create the tight monetary policies, the tight financial situations, okay, the tight financial markets that will cool inflation. If the market really feels like the Fed is bluffing, they're going to hike and then they're going to cut. There's no tight financial markets to cause the cooling that is necessary, okay? And what they say is the market thinks the Fed is playing without a playbook. Now, this is the case here, okay? Since their forecasts have been wrong before and they've downplayed them in the past, this is a chief market strategist at Bannock Burn Global, not familiar. We'll finish this conversation up after we talk to our man Kevin Hincks. We'll take a look at yields, folks. We'll talk the market. We got S&Ps up by 12. Stay tuned. Come back with our man Kevin Hincks. If you're looking for potential trading setups in the stock market, then Rocket Equities and Options Report is a newsletter you should try. Tommy O'Brien delivers options and equity trades when the markets present them, using a combination of fundamentals and technicals. Sign up for Rocket Equities and Options Report today with a 30-day money-back guarantee so you have nothing to risk. For all the details and to start your subscription today, visit the front page of TFNN.com. TFNN, educating investors.
Everything in the universe is governed by the Fibonacci sequence. This mathematical principle is responsible for everything from the most aesthetically pleasing artwork to patterns in the stock market. To stay on top of stock patterns you can take advantage of, sign up for the Fibonacci 24/7 newsletter at TFNN.com. When you subscribe, you'll get a weekly report from veteran day trader Larry Pesavento on stocks you need to pay attention to. And you can trust Larry's analysis. After all, he's got 45 years years' experience as a day trader. Larry will also provide daily charts, videos, and data on the key markets that he's tracking. Expect notifications from Larry on market movement you need to act on at any time. First-time subscribers also get a 30-day money-back guarantee. If you're not satisfied, let us know and you'll get a full refund within 30 days of signing up. Subscribe to the Fibonacci 24/7 newsletter today. TFNN.com, educating investors.
Steve Rhodes started his trading career as a student almost 20 years ago, and the student has now become the master. Steve won the prestigious Timer of the Year award in 2018 and barely missed that mark again in 2019, finishing at number 2 for the year. An amazing accomplishment. Steve Rhodes is committed to sharing his techniques and knowledge with anyone who wants to learn, and he shares his vast amount of trading knowledge every day in his Mastering Probability newsletter. Steve's award-winning newsletter, Mastering Probability, is delivered every trading day with updates throughout the afternoon. Sign up for Steve's market newsletter, Mastering Probability, and you'll receive access to 7 of Steve's educational webinars absolutely free. At TFNN, all our newsletters come with a 30-day money-back guarantee, so you have absolutely nothing to worry about. Visit TFNN.com and try Mastering Probability 30 days risk-free today. TFNN, educating investors.
TFNN has launched the Tiger's Den, hosted at Discord. TFNN has been educating traders for more than 20 years with live programming hosted by a variety of professional traders during market hours. The Tiger's Den, available to all tigers and tigresses for just $1 for the year. There's no catch or added costs when you join our community of traders. Sign up today and become a part of this educational community of traders. Just visit the front page of TFNN.com.
Welcome back, folks. We get the S&P's up by 15 points right now, trading at 39.56. NASDAQ 100, you're up by 35. Dow catching a bit, up by 102. And we got the Russell up by 5. We got all the banks coming out with their earnings on Friday. Let's jump around a bit. Wells Fargo in the news a little bit today. So they're getting out of the mortgage business. Let me jump over. I just had that article pulled up today. Well, we got mortgage refinance. Let's jump to this one first. So this story out this morning, rates down to 6.42% from 6.58%. Those are conforming balances of $647,000 or less. The drop in rates sparked a 5% increase in applications to refinance a home. I wish they dealt in real numbers, and maybe they do down this article. But don't be caught up in these small percentages on small numbers, folks, okay? The refinance market is very small right now. Percentages on small numbers can be deceiving, man. I say it all the time because this means nothing. Nothing at all when you look at that number, okay? Refinance applications are up. But guess what, folks? It's a tough market for refinances when you're pushing 6.5% to 7% across the board. Let's jump over to our man, Kevin Hincks. Every trading day, folks, 12 noon Eastern time, right here on Tiger TV, the TD Ameritrade Network with Fast Market. Your host, Kevin Hincks, Tom White, the whole team at TD Ameritrade Network. They got some great guests, folks. They walk you through hypothetical trades, usually 3 of them per the hour. They're talking about options. I've learned so much about options watching the program over the years. I encourage you to do the same, getting into that every day, 12 o'clock right here. Kevin Hincks, good morning.
Good morning, Tommy O'Brien. Yep, we wait for CPI tomorrow morning, and we have a market that is, dealing with some fairly good news. A little bit of, I heard your comments on mortgage applications. I mean, the housing market is still under a lot of pressure, Tommy, and pretty much reeling from higher interest rates. That market continues to wait for rates to stabilize, but you've got news out on Tesla this morning that's kind of interesting, and the comments that we were talking about on the air this morning, a bit of a 180 from Jamie Dimon in a Fox Business interview where he actually just a couple days ahead of his earnings release, talking about the U.S. consumer and the strength. And despite current economic environment, the consumer is still strong. That's a 180 from some of his comments he's made last April, last October, just a few weeks ago. So kind of interesting there that Jamie Dimon is reversing course on the overall weakness of the U.S. consumer, Tommy.
And I hadn't heard those, Kevin. So what happens is that Is good news bad news, though, Kevin? What happens if the consumer is too strong? Is that going to quell inflation? Isn't it amazing? That's where my head goes. But what do you think of that? Because, man, we have unemployment at 3.5%, Kevin. I don't know how we get out of. And what are we looking for tomorrow? I think the core number is supposed to come in at 5.7% CPI inflation. What does your mind do when you hear something like that? Because right away I try to do the gymnastics, and say, well, that's great for the economy, but does that mean that inflation is going to be more persistent than maybe some people think right now?
Well, I believe that the big problem on the horizon is where inflation plateaus, where it settles down, where it gets real sticky and stubborn on the downside. I frankly don't think it'll be 2%. I think it'll take a lot longer than people think to get to 2%. That being said, a lot of the enthusiasm for tomorrow's number, Tommy, is that consensus view for headline CPI month over month. The whispers are that it's going to be a negative number, and the markets will like not only something lower, but if that headline number comes in negative, the market will probably like that, Tommy. And yeah, you got the year-over-year numbers on headline 6.6 and core 5.7. Remember, we just came off a payrolls number where the wages data year-over-year was a pretty significant beat on the downside. So we'll see how fast inflation is coming down with what I think is the number one view of inflation. Non-farm payrolls is the number one data point of the month because you get so much information. But the number one look at inflation and prices is the CPI number that we'll get tomorrow morning, Tommy.
And I agree with you, man. And these are just opinions, folks. But, I think the core is supposed to be 5.7. I think that's down from 6. So you're only dropping 0.3 percentage points from 6%, right? Well, geez, if you do 0.3% every month, that's going to take 10 months to drop 3%. That gets the core. And folks, I'm ballparking all these numbers, but you see how things are supposed to be a little bit easier coming off 6%. And if we're only dropping 0.3% on the core year over year, then where are we going to be when we're trying to get from a number of 3.5 or a number of 4? And boy, we're going to get to see it all play out. We get CPI tomorrow, Kevin, and then we go right into bank earnings on Friday. What are you looking for some of the bank earnings? Speaking of Mr. Jamie Dimon and JP Morgan, that stock, man, well off $101 back in late October. You're pushing almost a 40% pop from those lows as we're trading at $139 right now for JP Morgan.
Yeah, here's the good and the bad and the uncertain about bank earnings, Tommy. The good, you're going to get net interest income is going to be a good number for these banks. The money that they store, because rates have gone higher, they're making more money on the money that they store. Here's the bad. Trading, deal making, IPOs, mergers and acquisitions all have basically ground to a halt. That's the problem. That's why you're seeing layoffs in some of these firms. Now, uncertain, Tommy, I think the bank CEOs are going to give you a real window into their soul when they put up loan loss reserves. That'll give you an idea of what they think about the economy going forward is the money that they put aside for losses. So those three things, net interest income will be really good. Trading, deal making, IPOs, mergers and acquisitions will be horrible. And then what are the loan loss reserves that they put aside will give you how they think about the future, Tommy.
Yeah, where are those defaults going to be? How much money do they have to have saved up to make sure they can weather it? It's interesting when they come out, man. We've seen it through the pandemic, right? They load up the reserves, and then sometimes they pull them out when they get out of the woodwork. Seems like it might be time to load them up again. With that in mind, Kevin, what are you guys talking about today coming up at 12 o'clock on Fast Market?
One of the final shows, Tommy, where we don't have to we can't deal with earnings yet. We'll look at Salesforce in the first segment. We'll look at Lifefolio will do a presentation on Best Buy, and then we'll look at KB Homes, some home builders, in the third segment. So we're all over the board today, Tommy. Salesforce, Best Buy, and KB Homes.
Salesforce, and I saw they got a little bit of a downgrade from somebody today. I saw they're down about $4. Man, this stock got hammered from $311, folks, all the way down to $124, $147. And I think I saw something about on that downgrade, something about a growth purgatory or something like that, man. So they're facing some problems like many growth stocks. See where they go. Well, Kevin, I appreciate the time on a busy morning as always, man. We look forward to the program at 12 o'clock, and we'll talk to you 24 hours from right now. And I can't wait, man, because we're going to be talking to you right after those CPI numbers tomorrow. We appreciate it, man. We'll be watching at 12 o'clock today, Kevin.
Thanks for having me on, Tommy. Have a great day.
Always a pleasure. Folks, check it out. 3 great stocks. You heard them. Salesforce. I mean, look at that chart, right, on that Thinkorswim platform, man. Almost giving it all up. They'll be talking about Best Buy. Take a look at the Best Buy. They almost gave it all back, too. How about it, right? Who would say that you thought all of these companies were going to give back the entire move from the COVID lows? Best Buy, $48 up to $141. You almost made 60, $60.79. Salesforce, $115 up to $311. We just hit a low of 126. And then they'll be talking a little bit of home builders, folks, at 12 o'clock. KB Homes, well off the lows of $25. You're trading at 35, but well off the highs of 52. Home builders, man, with the mortgage rates, always an interesting one. Check it out, folks, 12 o'clock. We're very fortunate to talk to Kevin every single day, Tuesday, Wednesdays, and Thursdays, that is, and 12 o'clock to be able to simulcast TD Ameritrade Network, folks, fast market. And there's your refinance demand. Up 5%. We'll talk a little bit more about this, but be careful of those percentages on small numbers, folks. We'll be right back for the open.
Building wealth trading in the stock market seems impossible to most people. They think it's too volatile and risky. Most people aren't going to take the time to educate themselves on how to do it right. But you're not most people, are you? At TFNN, you'll get the guidance you need to refine your strategies and techniques to invest like a pro. Because you'll be a pro. All TFNN subscriptions, books, software, and courses are available at TFNN.com. And I'm even going to tell you how to get them for less. Use TFNN's Tiger Dollars and you'll get up to a 20% bonus on your purchase. And once you apply them to your account, Tiger Dollars are automatically used for all future or recurring charges. Tiger Dollars also never expire, are fully transferable, and are a great way to add savings to your newsletters or services. Become the investor you were born to be at TFNN.com. TFNN, educating investors.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABCs, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Sharpening your skills as an investor is like getting better at playing a musical instrument. You have to practice, sure, but you also need excellent instruction from experts. At TFNN, you'll get advice and guidance from the authority in technical market analysis. And it's not just dry, tedious text either. TFNN airs live financial content streamed live on TFNN.com and TFNN's YouTube channel with Tiger TV, live every market day from 8:30 a.m. to 4 p.m. Eastern, for free. Each host is an experienced trader and gives their take on the market while taking calls and questions live from around the world. From the moment the market opens until the closing bell sounds, Tiger TV has 8 different shows with expert hosts to help you make the right moves with your money. Watch online at TFNN.com or on TFNN's YouTube channel and become the investor you were born to be. TFNN, educating investors.
This segment is brought to you by Thinkorswim. For more information, just click the Thinkorswim banner on the front page of TFNN.com.
Welcome back, folks. We got markets open. You're looking at an S&P basically opening right at highs right now, up 20 points at 39.60. You got the NASDAQ 100 up 60 points right now, trading 11,342, making highs. Look at the NASDAQ 100, man. You're within 40 points of the highs we had on Monday. Dow up 119 right now. You get the Russell up by 7 points right now. You jump to commodities, crude. Holding those highs, we were above 77. We're trading at 76.62. Gold contract, a little bit of a bid this morning, but off the highs at 18.90 or at 18.82. We jumped to commodities, currencies. Dollar, a little bit of weakness. in the last few minutes. You see the dollar drop from about 103.35 to 103.20 right now. We jump to the notes and bonds as we do our market wrap up on the open. 10-year just kind of chopping around where you've been. 10-year up 9 ticks, and you got the 30-year up by 24 ticks right now as markets catch a bid on the open. Okay. What else we got on here in terms of articles? Let's see. So jumping around to mortgages, okay? This one shouldn't be too surprising, as then I think the trend is for them to be getting out of this market in general, okay? But Wells Fargo, once the number one player in mortgages, is stepping back from the housing market. Instead of its previous goal of reaching as many Americans as possible, the company will now focus on home loans for existing bank and wealth management customers and borrowers in minority communities. They're very aware of the public relations mess that they are facing right now in general. The brand of Wells Fargo has been tarnished dramatically, rightfully so, for what they've been doing over the last probably 10, 20 years, right? They're shuttering its correspondent business that buys loans made by third-party lenders and significantly shrinking its mortgage servicing portfolio through asset sales. Okay, altogether, the shift will result in a fresh round of layoffs of the bank's mortgage operations, but they declined to quantify exactly how many jobs will be lost. Not surprising. Okay, this is how the rivals have gone. As a result of this and other changes, including for pushing for more revenue from investment banking, Wells Fargo is going to more closely resemble Bank of America and J.P. Morgan. Both companies ceded mortgage share after the 2008 financial crisis. So they're following the playbook, man, of some of the other big banks that have seemed to go well there. At banks step back from home loans, non-bank players, including Rocket Mortgage, quickly fill the void, but these new players aren't as closely regulated as the banks, and industry critics say they could expose consumers to the pitfalls. Today, Wells Fargo is still the third biggest mortgage lender after Rocket and United Wholesale Mortgage. Now, this is going to be a nice segue to Rocket. What is Rocket? Is it RKT? Rocket Companies. There you go. Let's see how this thing's doing. Yeah, watch out, man. Just crazy. So they pushed this thing out to the public in August of 2020. Okay. And I guess that spike was probably real. Was that a real spike going back? Let me back it up a little bit for a daily, 5 days. Yeah, I'm not sure. That was a volume. Was that an earnings spike? Maybe. I'm not sure what was happening in March 2021 that had that spike up to $40. You gave it back to 25 in a day. Maybe that was a little bit of meme mania, possibly, going on. You take that one day out of things, folks, okay? And this is where, I remember when this is happening. Now, Dan Gilbert owns this. He also, what's he got? Well, what else does he own? He owns what team? Maybe somebody in the den can help me out. He's got a couple teams, I think. But, folks, the point is, usually when you go to the public for money, you're raising capital, okay? You're raising capital to allow that company to grow in a way that it can't grow in if you don't have that capital. That's not what was happening. It was very clear that when they were going to the public, why would you ever sell shares of your company to the public if you thought that you were in a growth period? Well, folks, do you remember where interest rates were at this time? Let's pull them up, because this is a lesson in just thinking about things, okay? Because this one was very clear, in my opinion. I remember talking about it. Rocket, in August of 2020, now check it out. We'll go to the 10-year. Cleveland Cavaliers. Thank you, Peter. Definitely. August of 2020, man. Look at this. Look at this. It's the absolute high price in the 10-year. August 3rd. That correlates to the absolute low price, low yield. Okay? And I remember this happening and saying, you know what? They've been in an environment where they've been able to refinance forever. Okay? Basically. Okay? Now, yeah, there's your 2008. You had the pullback to 2018 when you had the taper tantrum. You got back to this high price, which is low yield. Okay? And what did he see, folks? He saw the writing on the wall that every single person in the country that wanted to refinance had refinanced. You had rates at basically, 2.5, 3% in the pandemic. Okay? We were already in August. The fiscal stimulus had come into things. And the real key here is, okay, is that they were not raising that money to do anything. They were raising that money simply to sell shares to the public instead of owning them. Why would you ever buy shares from a company when they're not going to use the money to grow? All they're doing is saying, I'm going to sell you shares in my company to take equity out of that company and put it in my pocket for cash. Well, who knows the most about any company? The people usually running it, if they're doing a good job, okay? So the people running Rocket had the best idea of probably where they were. They realized that it was a great time to cash out. They went to the public. They pushed it out to the public. You chopped around between 15, 25 or so forth. And now you're down at $6, $7, $8, man. And it's going to take a while, folks, to get back to that because, you're going to have years build up and it will come back. But just pay attention to that one. Because I remember when it was going out to the public, you had rates at basically 0%. Okay? And why would you ever buy into a mortgage company when everybody in the whole country has refinanced that can refinance at the lowest rates possible? And that's what they did. And smartly and very intelligently, they pushed it out to the public. They took some capital off of the table, and they did it at probably twice the valuation that you were going to get within a year or two. And that's what they did, man. So pay attention to that and just think about it because they didn't need that money. He did not need that money. That was a trade. That was a trade that Dan Gilbert made, getting out of Rocket shares and into something else, diversifying his portfolio. And it just didn't make sense, folks. Now, that's very different from a company going to the public markets for equity, for cash that they're going to use to grow that company. That's not what was happening. They didn't need that money. They could have stayed private. But they said, why would I stay private when our market is peaking? They didn't. It was a brilliant play, man, to push that out to the public. They got it done. Now you're at about $8. All right, S&Ps right up near these highs, man. 39.73. We're within about 10 points of the market highs that we saw on Monday. Interesting as we come into the CPI numbers tomorrow. Let's see what else we have going on in this market. What do I have pulled up here? Let's talk a little bit about rates. Top Chicago economists expect interest rates to peak around 5.5. Remember, right now, the market is pricing in 4.9% with a possible 50 basis point cut by the end of the year. There is a lot of room for higher rates, folks. I mean, the market expectation right now is almost a best case scenario, in my opinion. The market is pricing in a half point cut by the end of the year. Well, I think it's almost impossible to get more than that. And nothing's impossible. That's why I say almost, okay? But what's going to happen to the economy if you ever get more than a half point cut, 50 basis points, right? That's almost best case scenario. Well, if that's best case scenario and that's what the market's pricing in, where's your risk? Your risk is that they're going to go higher, man, because the risk isn't on the other side right now, folks. That's where I see it. The risk is not that they're going to squash inflation in a couple months and be cutting by a full percentage point by the end of this year. We'll talk to our man Teddy Kagstad. We'll get his take on things right when we get back, folks. Stay tuned.
You might think that if you want to be successful at trading in the stock market, you're going to need a crystal ball. After all, it's impossible to predict the future, right? Like any endeavor in life, before you decide it's impossible, get some advice from the experts. You might find that it's not so impossible after all. For daily market overviews that give you direction on the key indices, selective stocks, and commodities, subscribe to the Opening Call newsletter at TFNN.com. The Opening Call newsletter is written by Basil Chapman, creator of the trading methodology known as the Chapman Wave. The Chapman Wave up-down sequence gives you an edge in identifying price turns, finding the peaks and valleys in stock prices. Get the Opening Call newsletter by Basil Chapman in your inbox every day. First-time subscribers also get a 30-day money-back guarantee. If you're not satisfied, let us know, and you'll get a full refund within 30 days of signing up. TFNN.com, educating investors.
The technology around us is changing every day. With so much happening, it can seem impossible to keep up with all the information. David White's investment newsletter, The Technology Insider, is designed to give you all the information you need to understand the technology that shapes today's markets and tomorrow's future. David White has made his living staying on the cutting edge of technology. His weekly newsletter will give you specific recommendations for value tech stocks, as well as entry prices, target prices, and stops to set for each trade. Dave delivers his weekly newsletters every Friday with updates throughout the week. You can get the Technology Insider at TFNN.com for only $37.50. Sign up for David's newsletter, The Technology Insider, and get an inside look at everything the technology sector has to offer. Try it risk-free today with our 30-day money-back guarantee. TFNN, educating investors.
Will the S&P 500 continue to climb? For bold trades on U.S. large cap stocks in either direction, trade SPXL, SPUU, or SPXS. Directions Daily S&P 500 Bull and Bear Leveraged ETFs. Direction leveraged ETFs. An investor should carefully consider a fund's investment objective, risks, charges, and expenses before investing. A fund's prospectus and summary prospectus contain this and other information about Direction shares. To obtain a fund's prospectus and summary prospectus, call 866-476-7523 or visit directioninvestments.com. A fund's prospectus and summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
This program is brought to you by Vista Gold, traded on the NYSE American and TSX under the symbol VGZ.
Welcome back, folks. We have the S&Ps up by about 20 points right now. We're going to talk to our man, Teddy Kegstaff. Folks, if you head on over to the front page of TFNN, under the newsletters tab, you'll see the Tiger Forex report. Teddy puts out an outstanding report every Monday, folks, with updates throughout the week when warranted. You can just hit the subscribe button. It's $97 for the month, folks. You gain access to a webinar he has in there as well. There's your $97. You get it for a month. You get the 60-minute webinar in there as well, Forex strategies and fundamentals, what is behind the Tiger Forex Report newsletter, and you get a money-back guarantee. You keep it for 30 days. You're not happy. It's not something you can use. You cancel it, get your money back. You can't go wrong, folks. Check it out on the front page. Teddy Kegstaff, good morning.
Good morning, Tommy.
So, where do we go, Teddy? We got crude catching a little bit of a bid this week, but still relatively lower prices considering. We have the market catching a little bit of a bid, and we got CPI numbers starting out tomorrow. Where do you want to start off in the markets, Teddy?
Well, I like the crude with the higher move low that it set a couple sessions back, and I think it's going to be pretty stable to higher. I'm not looking for a major rally, but I don't think you're going to see any type of sell-off really in the crude oil market. I think it's going to be pretty stable here. So at least that's what I'm looking at in the short run.
Pretty interesting. We're seeing prices, Teddy, of like $70, $72 from a risk-reward perspective, man. With everything going on in the markets, you have China opening back up. That's some of the rhetoric going on this week. Pretty interesting, at least that, that is kind of a floor of $70 because risk-reward-wise, just in my own head, man, it'd be pretty remarkable if we cascade even lower prices considering the risks that are present as we go on into the winter months really right now. Well, we're in the winter months right now.
Sure, exactly. I agree with you 100%. So, yeah, I think that as far as the potential for a move, the downside, there's not that much there. I would look to be a buyer of breaks in the crude oil for sure.
Nice. How about the dollar index, man? We've just been kind of cascading to a little bit of lower prices. We're at 103.21 maybe this morning. What's your take on general dollar behavior this morning?
You know what? It's pretty much it's just almost like divergence is starting to happen. The only weakness that the dollar has today is in the euro and also in the Swiss franc. So, and I really don't. I would have to say, when you look at the other markets, and the key is if you look at what's going on with the bonds and the 10-year right now, you have a 3-to-1 differential with the bonds leading the charge for lower yields right now. And usually when you have that differential on a daily basis, you're going to have a rubber band effect. And I think that the 30-year is driving the yields lower and trying to pull the short terms down, and because of that differential, you have to watch the 30-year. When that falls back and yields start to go up, that's going to snap back, and you're going to see that relationship close to closer to a 2-to-1 ratio. And if that really starts to move, that means the short terms, just a little bit of a pullback there is going to bring a big pullback in the 30-year, and that would give a lift to the U.S. dollar. And I think that's where you'll see the euro start to pull back, and also the Swiss, because the dollar index as a whole is very neutral today. And if you look at it, like the Australian dollar, like the euro is making a higher move high, against the dollar, on a weekly and daily basis, but it's the only one. The pound is actually lower on the day. So, so the euro is the biggest part of the dollar index, but the pound is the second biggest, and it's not moving. And the U.S. dollar yen is also strong for the dollar. So that tells me that you have a little bit of a divergence happening. So if you're a euro trader or a Swiss trader, I would be careful, keep my stops tight, because if you see yields pop back higher, especially with the big sell-off in the 30-year, which we could easily see, unemployment, we had a spike low or high, depending on which currency pair you were trading last week, So now the reality is CPI going to do what unemployment did, and the number that came out with the unemployment there, you're talking about the Fed only doing a quarter point over the next 2 meetings and then stopping. Well, if unemployment keeps on staying where it's at or goes lower, the Fed's going to keep on raising rates. They want higher unemployment. They don't want lower unemployment. So then they got to fight inflation and unemployment, because they want to touch off a recession. So if that's if that's their mantra and they're going to stick to it, you got to factor in accept the factor that the market already has the next half point factored in. Okay. But if these other numbers really start to say that the Fed is not going to ease up, that means that the market they have to start going for higher yields, meaning lower prices and also a stronger dollar as well.
Yeah. What did you think of the market reaction to that non-farm payroll number? You referenced it, man. We saw unemployment drop to 3.5%. Wages caught a lot of attention there. But boy, and we're sitting right now, that was at about 38.19. I got the spike low on that Friday on the S&Ps. We're about 140 points higher right now, challenging the highs we almost saw on Monday. What did you think about the market reaction? Because the market reaction was, boy, the wage numbers, are not increasing as much as the market expected. So that was that, okay, are they going to start cooling wages, which will help inflation? But I kind of went back to the same thing you were saying, man, saying if we got unemployment at 3.5% right now, and we have CPI coming out tomorrow, core is supposed to be 5.7%. It seems like, and then, I don't know if you heard the start of the program, man, we got a meeting at the end of this month. We have one in March, and then you got to go all the way out to May. Very difficult for me to see how, we get enough data over the course of just 2 or 3 meetings for the Fed to make any kind of dramatic change. It would kind of be shocking right now, I think, I
agree with you 100%. I totally agree with you. And that's where, I've been saying this for a past month and a half, that as we come into 2023, the Fed is not going to be raising at the aggressive rate that they were over the past year. But as far as when they're stopping, they need to have these, what they've been doing has been trying to curb inflation, curb this, and also raise this. And some of it has been working, and to some of it, it's not. And if those things are that important to them on their agenda, well, why would they stop raising rates? And with other central banks raising rates too, it cancels out a lot of it. So, I mean, the media is looking very short term, being like, well, they're not going to raise rates forever. Well, if you keep calling it a top or a bottom every single day, eventually you're going to be right, and that's what they're doing right now. And I wouldn't second guess the Fed right now until we really see reactionary numbers. Now, if we have a CPI number that totally falls in line with what they're looking for, and other things that really start to look like that going into the next month, well, maybe you can start to see that maybe they'll start pausing, come May. But I don't see that happening at all, especially if you keep if the employment number in 2 months from now is right about where it's at right now, or in 3 months from now, then I think you're going to see the Fed at least raising at least another 1 or 2 times over those next following meetings, So is it going to be aggressive? I highly doubt it. I think you're looking at a quarter point at best. But still, that's stuff that the market, I don't think, has factored in. I think the market has at best, a half a point over the next 2 to 3 meetings. I don't think it has a full point factored in over the next 4, which I think it could actually be,
And that's where I was talking about right before we came with you. I see a lot of the risk, man, where the market's basically pricing in almost a best case scenario right now, because I don't see any way that it's going to be quicker than what the market's thinking in terms of, I was talking about they're looking for potentially a 50 basis point cut by the end of the year. How do we get there when we're waiting almost until the May meeting where they might stop, and then you're going to go 50? I mean, there just have to be such economic data that lines up to it. And we're still, folks, at a number that we have unemployment going down to 3.5%. So keep that in mind as these numbers go forward.
They're not going to cut until we have a lot of recessionary numbers. That's when they'll put the brakes on. And guess what, my friend? That ain't happening for a while, because
and even the pausing, like you say, even the pausing, man, I find it very difficult to pause if the numbers are where they are right now. I mean, we're talking about, headline numbers in the 6s for inflation, core numbers in the high 5s, and an unemployment rate at 3.5%, man. Well, Teddy, I appreciate the time as always, man. Folks, check out the Tiger Forex Report, outstanding newsletter, and I look forward to talking to you next Wednesday, Teddy.
Sounds good. Take care, Tom.
Okay, man. Have a great one. Stay tuned, folks. We'll be right back to finish up the show.
TFNN has just launched their new trading room, the Tiger's Den. Hosted at Discord, TFNN has been educating traders for more than 20 years with live programming hosted by a variety of professional traders during market hours. And now they are expanding their reach with the Tiger's Den, available to all tigers and tigresses for just $1 for the year. There's no catch or added costs when you join our community of traders. In the Tiger's Den, you can look over the shoulders of Tom O'Brien and the other TFNN hosts while they analyze charts during their live Tiger TV programs, and join an interactive trading community with hundreds of members exchanging ideas. Interact with other tigers and tigresses as they share trading ideas, news analysis, and discuss the market action all trading day, even at night and on the weekends. The Tiger's Den at Discord is accessible on mobile or tablets as well, so it's always at your reach. To sign up today and become a part of this educational community of traders, just visit the front page of TFNN.com.
You might think that if you want to be successful at trading in the stock market, you're going to need a crystal ball. After all, it's impossible to predict the future, right? Like any endeavor in life, before you decide it's impossible, get some advice from the experts. You might find that it's not so impossible after all. For daily market overviews that give you direction on the key indices, selective stocks, and commodities, subscribe to the Opening Call newsletter at TFNN.com. The Opening Call newsletter is written by Basil Chapman, creator of the trading methodology known as the Chapman Wave. The Chapman Wave up-down sequence gives you an edge in identifying price turns, finding the peaks and valleys in stock prices. Get the Opening Call newsletter by Basil Chapman in your inbox every day. First-time subscribers also get a 30-day money-back guarantee. If you're not satisfied, let us know, and you'll get a full refund within 30 days of signing up. TFNN.com, educating investors.
Everything in the universe is governed by the Fibonacci sequence. This mathematical principle is responsible for everything from the most aesthetically pleasing artwork to patterns in the stock market. To stay on top of stock patterns you can take advantage of, sign up for the Fibonacci 24/7 newsletter at TFNN.com. When you subscribe, you'll get a weekly report from veteran day trader Larry Pesavento on stocks you need to pay attention to. And you can trust Larry's analysis. After all, he's got 45 years experience as a day trader. Larry will also provide daily charts, videos, and data on the key markets that he's tracking. Expect notifications from Larry on market movement you need to act on at any time. First-time subscribers also get a 30-day money-back guarantee. If you're not satisfied, let us know and you'll get a full refund within 30 days of signing up. Subscribe to the Fibonacci 24/7 newsletter today. TFNN.com, educating investors.
This segment is brought to you by Thinkorswim. For more information, just click the Thinkorswim banner on the front page of TFNN.com.
Welcome back, folks. Checking back in on the markets this morning. We got the S&Ps up about 16 points. You see a little volatility, man. We were just up to 39.66. You're back to 39.58 right now. And, folks, we're fortunate to talk to Teddy every Wednesday, man. We're fortunate to have him writing a great newsletter. This is a quick peek, okay, in terms of the Tiger Forex report that Teddy just put out Monday morning. You see he goes over the dollar, of course. He goes over crude. He goes over T-bond futures, okay? He's talking about the euro dollar. He's talking about the pound. He's talking about the Swiss franc in there. He's talking about the dollar yen. He's talking about the Aussie dollar, New Zealand dollar, dollar Canadian, all right? It's a great report, folks. Check it out. A lot of great information, and it goes well beyond Forex markets because Forex, yields, bonds, it's all one big pool in terms of how things are trading right now in this market. And jumping back in terms of what else I had pulled up here, how about the FAA this morning, just in terms of things happening? Did you see this one, man? Be interesting to see how they pull this one out in terms of what happened. They had to basically stop all domestic departures for almost a couple hours early in the morning, man. The hit on the economy, folks. I mean, these are big numbers, man. You just stop air travel for a couple hours in the morning. But the FAA ordered airlines to pause domestic departures, but lifted it just before 9 a.m. Eastern time. It said that everybody was safe in the air. And that they were able to get that back up. By 8:15 in the morning, flights were resuming out of Newark and Atlanta, and and it's a quote-unquote technology issue. But, man, you talk about technology, man. This is going to be one of the things, folks, as our lives revolve around technology. You know, everything is going to be cloud-based, and what happens when we have some of those outages? It's going to happen, so we'll see. This morning, S&P is holding up well, man. We get that CPI number tomorrow, and as I'm going to pull it up, let me pull it up one more time to get the numbers in terms of what we're looking at for the headline CPI. We're coming out tomorrow, folks. Okay, we're talking about a number. Now, we're talking about December CPI tomorrow morning. Headline, 6.6% is what they're looking for. Core, 5.7%. Month-over-month core, and they heard our man Kevin Hincks. Month-over-month headline, you might see a decrease. Look at the month-over-month core, because you're looking for a rise of 0.3%, which would actually be up from 0.2% in November. Lots of big numbers, man. And then we get the banks on Friday. Thanks so much for starting your day with me, folks. Stay tuned. Live programming. Basil, Steve, Fast Market, Larry, Dave, and Tom this afternoon. Have a great Wednesday, everybody.